Well, hello and welcome to Trading Blows. Plenty for us to discuss in our first show in a long time, including last week's busy central bank decision slate, including the Bank of Japan exiting negative interest rates, the Fed looking desperate to cut, and other central banks looking like they want to ease policy as quickly as they possibly can and taking dovish steps of their own. Of course, amidst all of this, the dollar continuing to move higher and equities continuing to rally as well. Plenty for myself and the panel to get into this week. So without further ado, let's roll the titles and get into the show. So plenty for us to discuss, as I mentioned this week. Joining me on the show, Adam Linton, the head of the European desk over at Newsquawk, Richard Matthews, the head of FX payments and partnerships over at One.io, and Ioan Smith, the market veteran of the sell side and his own research firms. Of course, the panel will score points for great answers to the questions, and they have the threat of points being chalked off looming over them if a dispute is raised over their answer. With the panel in the show, let's get on with the first round and dig into the FOMC last week. So, Dick, I want to start with you, actually, because I think you're probably going to have the most controversial view of everyone on this one. The Fed meeting last week, to me, they seemed desperate to cut rates. They raised their expectations for core PCE this year to 2.6 from 2.4%, but the dot plot still indicated that they plan to cut rates 3 times, 75 basis points worth of cuts this year. Do you think that this is a logical and a rational view that the Fed are taking of the US economy? Or, I mean, last time we spoke, you were saying the Fed is still going to hike. Do you think that that's their next move? Being first, does that mean I also go last? I have to talk about the Bank of England as well. Because if so, maybe
I'm going to get my doctor on the phone to get my blood pressure pills upped. Good day to everyone. I don't know whether it's going out tomorrow morning or this afternoon or whenever. He was absolutely desperate, wasn't he, pal? Really interesting change in attitude. I thought he'd come out hawkish. I would test whether Ryan's listening to this. I've actually changed my view. I don't think they will hike now. I think they will cut.
You've actually seen sense at last, have you?
Sorry?
You've seen sense at last.
Cut. Yeah. He needs to take his medication. Cut.
Yeah, cut. Hold on, where's my medication? I think they will now cut purely because of his language. It seems bonkers to me because I actually think inflation is rearing its ugly head again. You've got PCE coming out this Friday, nice quiet afternoon. That will be in a very thin market. Could be some good volatility month end. It's going to be lovely fun.
Newsquawk desk will still be open for all our clients, by the way, servicing all your market needs.
Okay,
I hope you've made Henna's the intern work that shift, Adam.
Yeah, the desk is open. I won't be on it.
It's an advertising break. We sort of get a flag out for that. And then you got Jolts on Tuesday, I think, which could be again an interesting figure. To me, I know Mike and I spoke about this some time ago about American exceptionalism. I still think it is an exceptional economy, and we have to look at the states completely separately to anything else. What's pushing him? Is it the fear that there's something happening in a regional bank because of real estate, commercial real estate problems? Not so convinced about that, although Yellen has sort of made me wonder about that. Is it political pressure? I think it could be. I don't think Powell wants to see Trump back. I think he wants to see Biden. Trump absolutely crucified him the last time he was in power. Why would he want to put up with that? So I think there's a little bit of that thought process going through, and I think he'll get the economy going, really flying, get housing back up to good levels, bring inflation back, but then that's going to be the new president's problem, not his so much. I don't think he should cut, but I think he will cut. And of course, they've got a lot of stock to sell. The deficit there is expanding. I read by $1 trillion every 100 days. I'm sure one of you guys knows whether that's true or not, but it sounds a frighteningly large number. And of course, if you're going to move rates downwards, buy your stock now before interest rates drop on it. So I think there are good reasons for him to do it. From his own book, I think he's wrong. I think they should be hiking, but that's why I'm not a central banker and he is.
Well, I was going to say, if Dick Matthews was in charge of the Fed, the S&P would be trading at about 2,500 at the moment, I think, given the amount of hikes that you would want to deliver. Adam,
I'm now going to make sure whether Ryan's listening, so he'll be on the phone immediately. He hears that I've admitted that they're not going to hike rates. I think they will change their inflation target. I think they'll change it to 2 to 3%, and they'll get away with it that way.
Yeah, see, that's actually an area where I agree with you. And I wrote a note on this last week. I think that, my big takeaway, I think, from the March FOMC was that they are now moving into targeting an inflation range rather than necessarily targeting an explicit 2%, because all of the language is they want to see inflation moving towards 2% rather than actually getting and achieving that 2% exactly before delivering the first cuts. I mean, Adam, I want to bring you in. What were your thoughts on what Powell and co had to say last week? I mean, the statement was pretty much a copy and paste job from what we saw in January, but risk rallied nonetheless.
I think ultimately, the market's looking towards June as the first time for the rate cut to take place. And I think ultimately they're just playing for time until we get there. I think, you got to frame the debate about a rate cut in the context of we're making things slightly less restrictive rather than an outright easing cycle here. And I think, if you take the US data as a whole, I think there's quite a lot of mixed messages going on. I think there's very much in a case of something for everyone. So I think the trajectory is heading towards an ease, but in terms of the pixel time at the moment, I think there's a lot of mixed messages. I think.
Whoa! Sorry, can I take a point off for pixel time?
I've used it before. I'll use it again.
That's 2 points off then.
Horrible saying.
What's the saying?
I'll stop saying it if you stop referring to the pound as the quid. I hate that.
Okay, we have a deal. We have a truce. Don't worry.
Okay. But yeah, I think there's a lot of mixed messages in the US data at the moment. The inflation data for January and February, that was a bit warmer than some people would have tolerated. But then we've seen Powell downplay that at the latest press conference. I think the jobs market, we've been blown away with some of the headline top line payrolls growth. But then in the household survey, we've seen the unemployment rate tick higher. And then in wages, we've seen relatively muted growth on that front. I think, we're yet to see any kind of hard data for Q1 on the growth front, but the PMIs, they're still looking relatively robust. Manufacturing looks like it's bottoming out. Then on the consumer side, the January retail sales, that was pretty soft. February, the control group, that was at 0%. And then, elsewhere, financial conditions, they've been easing. The 30-year mortgage rate, that's pulled back about 100 basis points since November. So I think there is quite a lot of moving parts here. I don't think there's a real clear narrative for either camp to kind of declare victory at this stage. But ultimately, it's about getting things less restrictive. And, the thing I've got to remember is if inflation is coming down, that is if they do nothing, then through real yields, they're going to be tightening policy. So in order to keep the same level of restrictiveness, if inflation is coming down, then they're going to have to cut anyway. So it's not, I think people need to not get too carried away from that. And also, they've got plenty of scope to cut. It was the long-term estimate of the Fed funds rate is, 2.5 to 2.75%. So
yes,
we're about 275 basis points above that. We've got plenty of room to be cutting. And I think ultimately, I think one of the framings of this is, are they right to go in June? But I don't think it particularly matters if they go June, July. I think the success and the review of the Fed's efforts will be determined, when this kind of cutting cycle is done, because I think it's more about the end destination rather than does it start 1 month here or 1 month there. And then, ultimately, I'd say, I think it's something I'll touch on later, is that we've got so much data in between now and then. We've got 3 CPI reports, 3 jobs reports. And if anyone's looking for anything, to kind of frame how they're looking for the Fed to play out this year, I think the report due on April the 10th, is it? The March one? I think that's one of the most important inflation reports we'll have had for quite a while, because that will either confirm that Powell was right, and there's a lot of seasonal factors at play here, or it might give the Fed something to think about.
Yeah, I very much agree with that one. I think it's easy for Powell and other policymakers on the FOMC to sort of palm off the noise in the data in January and February. But all of a sudden, if you're looking at, well, it would be 4 months if we get an upside surprise on the March inflation number. If you have 4 consecutive figures that come in hotter than expected, all of a sudden that becomes very, very difficult to ignore, and you may well be looking at a very, very different policy outlook. Ioan, I want to bring you into the conversation. I think Adam raised a good point there in that, are we looking at this the right way? The Fed are cutting rates, yes, but are they just cutting to effectively maintain the same policy stance as inflation continues to move back towards 2%? It's not necessarily policy loosening or policy easing. It's more just maintaining where they are at the moment, perhaps.
I think so. I think they've sort of got to, the ceiling where they wanted to go. They gave themselves, they accelerated as fast as they could to give themselves a bit of wiggle room if the economy did sort of slip into a downturn. But having said that, I agree with you. I think that, they will change the inflation target. I think it makes it easier for them and gives them a hell of a lot more flexibility if they offer a range of 2 to 3%. They have a lot more wiggle room with what they could do then. But, saying that, like you said, Powell indicated that this is it for probably the hikes for this cycle. And there's, but the burning question is now, is when they will begin to ease. Does it actually matter? If they've signaled that this is the top, then I think the market doesn't really pivot around, which month a cut will eventually come. If they're signaling that the top is in terms of rate hikes, then everybody else sort of moves around there. So I think now, as we said, we've got a lot of data points in between there, but I think the summary of economic projections now, they're gonna start giving us more color, or they should be, poured over for a little bit more indication of where the FOMC stands with their own forecasts. As we've sort of already said, Powell said that the expectations are for rate cuts this year if the data supports it. But, that 2% objective isn't going to come anywhere, isn't going to come into view anytime soon. Shelter costs are still elevated. Non-housing services are not falling as much as commodity prices. So there's always something in the background that will keep them occupied. But, that may mean that the expectations for 75 basis point cuts by the end of next year gets pushed back, and I don't think it matters if it gets pushed out further.
Yeah, that's actually a point that I would very much agree with. I think, personally, the way I view the market at the moment is it's the direction of travel for policy that matters more than when the Fed cut. As you rightly said, Ioan, Powell has said that we're pretty much at the top in terms of rates for this cycle. The next move is going to be lower. If it comes in May, June, July, September, does it matter? Arguably not, because the market knows that the Fed has its back once more. But Dick, I want to just wrap up with you, because I'm sure you take a different view on that one.
You broke up, actually.
That's convenient.
Convenient. Say again, Michael. You did actually break up. I didn't catch it.
All right. No, I was saying the point that we actually made this time last week, where it's the direction of travel of rates and the fact that the market knows the Fed has its back once more, that really matters a lot more significantly than, if the Fed cut in June or July. Yeah,
absolutely. It couldn't scream more. The only thing it does do, if they cut earlier, then they can cut more before the election in November. I guess that's the only thing that might matter. But I think the direction of travel's there. The market now knows that. What I think is quite interesting is that to me is interesting, is that they're in a completely different place to Europe and the UK, and the reasons to cut are different in the States.
Yes, very much so. We will save your thoughts on the UK, because I've put the BOE last in this show, just to keep you in suspense. So let's move on to Japan, where the policy direction is totally different to what's happening elsewhere in developed markets. So, yes, I do want to get on to Japan because I think it's a very, very interesting story what's going on over there at the moment. Obviously, the Bank of Japan ending that almost decade-long experiment with negative interest rates last week, becoming the final central bank to move rates back into positive territory. Adam, let's start with you. I mean, I don't know about you, but I had a very, very early start last Tuesday when the BOJ started to normalise policy. How are you viewing things in terms of the Bank of Japan at the moment? I know we discussed this at length last year. Do you think that they're going to become this hawkish outlier within G10 central banks, or is it more a case of, now is the opportunity to get rates back to zero and then we just sit here for a while?
On my previous appearances on the show last year, I was very much a skeptic that the BOJ were going to be hiking rates as the rest of the world was cutting. And other than the S&B, we haven't really seen anyone cut thus far. And the BOJ has kind of been able to get ahead of it to some extent. But in terms of the longevity of this hiking cycle, whatever you want to call it, I think it is pretty telling that the BOJ's mouthpiece, i.e. the Nikkei, came out with an article straight away saying that July or October, most likely October, will probably be the next hike. So to me, that shows they're trying to control the messaging in the media aftermath. And there's no real rush, because one thing that they need to do, and this was mentioned in the article, is they actually need to see what the impact of ending negative rates is. This isn't a conventional monetary policy that we've seen. It's not something that they've experienced in Japan. So they have every incentive to take their time, see what the impact on the banking sector is, see what happens with inflation, wage negotiations. So there's no real, from a purely economic perspective, for them to be rushing this. The big elephant in the room, of course, is the Japanese yen. And, I think a lot of people, it's very much a buy the rumor, sell the facts kind of price action on the day. And that's because people think this is going to be a relatively shallow hiking cycle, and there's not really going to be too much to come from it. That's why we've seen the yen, I think it's overnight, took out the 2023 and 2022 highs. And now there's not really much until 155, because we talked about real yields of the Fed in Japan, they're negative. And therefore, some hopes that Japan could be, the yen's role ended in the carry trade just isn't happening at all. So I think the thing that could stop this is potentially the BOJ needing to get more aggressive to control the yen. But I don't think there's really anything that they can do at the moment. I think, any intervention that Japanese officials make is just going to go down like a lead balloon. People aren't going to take it seriously, because ultimately, I think, from an FX perspective, the BOJ and everyone in Japan is hoping that the Fed can start doing some of the heavy lifting for them. They hope that when the Fed starts cutting rates in, June, July, whenever we want to call it, that'll do some of the heavy lifting, and then, could get dollar yen down towards 140. So I think they're just basically playing for time to see how their own actions play out and those of the Fed.
Yes, I think that's a great point. It is a very, very patient stance. I mean, I put out a semi-joking tweet earlier saying that, if the Ministry of Finance in Japan really want to, stop the yen from basically falling through the floor, just get the Bank of Japan to hike a couple of 100 basis points, because a tightening of that yield differential between Japan and the US is really the only thing that is actually going to support the yen sustainably in the long term. I mean, what are your views on that? Obviously, dollar yen trading close to that 152 handle once more. That's kind of been what appears to be a bit of a line in the sand. Do you think the Ministry of Finance are going to come in with intervention? And I guess more importantly, do you think that this is actually a sustainable way to conduct policy?
Well, I think that, like you said, they're 152 at that level. I mean, when you say it's a line in the sand, I think that was where, the Bank of Japan basically intervened for the last time back about 2 years ago, right? So I think it was around that level then. I mean, that level held late last year. So, again, that was with the help of verbal intervention and of course, US rates. But I don't know, it's interesting. It's like Adam mentioned there, the piece in the Nikkei where they were talking about October being the next move. I think the Bank of Japan, itself probably diluted the impact of that hike, because I mean they suggested that it's not really an exit from easy monetary policy, and nor is it the start of a tightening cycle. But, having said that, swaps market's pricing, I don't know, an additional, 21 basis points by the end of this year. So that's up 11 basis points from where it is now. Having said that, the Japanese officials, I think they're genuinely surprised that the yen didn't strengthen after they hiked. But I think, people have probably preempted it to some extent. They pre-positioned for such a move. And to be honest with you, when you look at positioning, especially in the futures market, the net short position is like $9.5 billion. So, it's slightly smaller than it was at the end of last month. But having said that, it's still at like decade high levels in terms of short positioning. So I can't see much in terms of yen strength over the next quarter anyway.
Yeah, I would very much agree with that, actually. I think the other thing to consider, and Dick, I don't want to steal your thunder before I bring you in, is that, if you look at the Fed and you look at the BOJ in particular, which way do the risks tilt? Well, you would naturally say that the risks tilt towards the Fed being more hawkish than the dots and the market path would imply, and the risks tilt towards the BOJ being more dovish than those two factors would imply. So, again, you're talking about further upside in dollar yen and further weakness in the yen naturally. Dick, what are your thoughts on this? I guess you're sort of pleased as punch. You've been crying out for central banks to continue hiking. The BOJ have delivered that 10 basis point hike. I guess you cracked the champagne early last Tuesday morning and were celebrating, were you?
I was fast asleep. I may have cracked a bottle of champagne whilst I was snoozing.
Which country were you in?
Yeah, no, I think I was probably in Monaco. Does a hike of 10 basis points really count as a hike? It's more of a Roger Moore raised eyebrow in my book. And were they really surprised by the market's reaction? It was such a well-telegraphed move, wasn't it? I think the market knew it was coming, and that's why it's behaved the way it has. I think you will see some intervention. 155 seems to be the level that everyone's talking about. If you're going to see it and it gets anywhere towards that in the next couple of days, I think you might see something over Easter. It's a perfect time to intervene. Thin markets, month-end volatility, which we all love. But you've got every religious holiday going on in the world. You've got Jewish Purim, you've got Ramadan, you've got Easter. So I just think might be a good opportunity for them to come in and do something. But if they do, what's it going to do? It's going to move it a couple of points and it'll rally back up again, because fundamentally, it's just a brilliant carry trade, isn't it? And with yield differentials the way they are, that's not going to go away. The Fed isn't going to. Oh God, I can almost swallow my tongue saying the Fed's not going to cut enough to discourage people doing that carry trade any more than the Japanese are going to hike. So really, really difficult.
I think, just sorry to interrupt, I think that is a good point that Dickie's making about Friday, because it's going to be quiet markets, FX markets will be open, and then we have the curveball of the PC report in the middle of that. So, I think there's no one praying for a softer PC report than, Japanese authorities, and it could give them an opportunity to try and do something. But as Dickie says, it probably isn't going to be too sustained.
No.
Is Newsquawk open that day?
Newsquawk?
Sorry. Are the Squawk services open that day, in particular Newsquawk?
Newsquawk will be running a special service for our clients, because that's what we do over at Newsquawk.
Fantastic. And Peppers, are you around on Friday, Michael?
Oh, Dick, you know me, mate. I'm always around, chained to my desk over here. What I did want to mention, just CC Chris Weston in that last remark, is there was an interesting message put out on Twitter this morning from a certain account raising the prospect of the BOJ and the Ministry of Finance intervening over the Easter period. So if they do, the blame is being placed firmly at the feet of whoever was in control of the Newsquawk Twitter at about 6 o'clock this morning for tempting fate and goading them into it, Mr. Linton.
In the words of Shaggy, it wasn't me.
And what a great note to move on to the next round. Okay, so with the Fed and the BOJ out of the way, I want to get into the equity market a little bit more because the grind higher continues, not just on Wall Street, but also pretty much across the globe. If you look here in Europe, if you look in Japan, where we just were, equities continuing to trade very, very close to or at fresh all-time highs. Ioan, let's kick off with you. I mean, do you think that this rally that we're seeing at the moment is sustainable, or do you actually see some risks beginning to emerge for those who are bullish on equities at the moment?
Well, to be honest, they're given such the moves. I think there's always a risk that it's overextended, right? I mean, if we look at a couple of indicators like the dumb money, smart money, the spread's quite low, suggests that dumb money's joined in, fear of missing out. Whereas the institutions have probably stepped to the side a little, and then you can read in with that, in conjunction with that, the put-call ratio. I just use a simple moving average of about 20 days. That's the lowest since February 22. So it suggests like some institutions are taking money off the table, and I keep in some upside exposure through call options, but at the same time, it seems as if people are not really buying puts to as insurance for any downside. There's a couple of things on my radar that I'm looking at. I mean, obviously the CTAs there's about 165 billion long of global equities at the moment. I think that's 3-year highs. So I think that's important to watch and see if there's any downtick in that. That suggests obviously that there's some momentum build up, and recent equity flow trends. It could it's been a precursor for a bullish run. But I'm looking at now at the blackout window for buybacks. I mean, during the peak of the blackout period, I think that takes about $5 billion daily out of supported flows. So that could drop off. I think that'll be in April. And the other thing that we need to consider is the tax returns in the US. I think April the 15th is the deadline there. Does take out another form of supported liquidity in the market. So just a couple of points there. I'm not necessarily chasing it too much at these levels. I'd rather get some upside exposure or via calls, but other than that, I wouldn't be putting my whole portfolio of fresh money into buying the market at these levels.
No, I think that's an interesting perspective, and of course, options is always an interesting way to play the market. Mr. Matthews, the S&P 500 trades right now 52.75. So I'm going to give you the question that no one would want to answer. Which way are the next 200 points? 54.75 or 50.75?
Could be 100 up and 100 back down. That could be next 200.
Oh, get off the fence! Come on.
100 up and 100 back down. I guess you put it.
I call him Humpty Dumpty.
I'm going to go with the market. I guess up. I don't particularly believe in it. I think that there are, and I'm going to get accused of being a warmonger. I think there's huge geopolitical risks which we haven't discussed out there. Certainly with the Houthis. I've just actually got a text. I don't know if you saw me look at my phone from someone who's involved in that, and that they are very well armed. I think that problem hasn't gone away. I think Russia could accelerate in what it's doing in Ukraine. It's a very strange story, this whole ISIS thing. I guess it's a false flag, but I think that there's something going to come out of that. So I'm worried about these geopolitical risks. As always, I think Japan and the States are getting very close in confronting China. So that's my worry on it. The upside, I guess, is Trump and Biden both going to be good for equities. So people are happy with that. A question I throw out there, though, is AI. I think it's really, really interesting. But what does it do? Because it benefits a certain number of companies, but other companies will completely put out of business. And I just wonder how the component parts of the S&P will change over the coming years and what impact that will have. And the other thing, I'm not a great equities watcher, but the other thing I did notice was that Apple were asking Google to help them develop AI phone. So God knows what an AI phone is. Does it tell you when to stop texting when you're drunk? I don't know. And I just wonder whether Apple has peaked.
It tells you where the S&P is going to be in there, whether it's up 100 or down 100.
That's exactly what we need. I wish I had. But I just wonder whether Apple has peaked and whether that impacts the market long term. But I guess at the moment you've got to go with the flow. I don't believe it, but I think next 200's up.
Well, I was about to say, I wish my phone would tell me to stop texting when I'm drunk, but that's another matter. I want to take you on a point that you just made around geopolitical risk, and I'll throw this out to all of you. To what extent is the market insulated from geopolitical risk by the supportive and what is likely to become an increasingly supportive monetary policy backdrop, with rate cuts coming and an end to quantitative tightening coming and all the rest of
it? I think
don't all speak at once, don't worry.
I think the market is very nonplussed by geopolitics at the moment, is my kind of top line summary.
Yeah, I can't disagree. However, I think that there is a potential for something really to get out of hand. Missile flies into Poland by mistake, and all else kicks off.
I think of the existing kind of more warfare-based conflicts, I don't think they're really having an impact. I think the main geopolitical kind of prism we'll be looking at things as we head towards November will probably be more US-China. I think it's the one thing that both sides are going to be unified on is a tough stance on China. That's very much a vote winner in the US. Obviously, we know Trump's feelings towards China. If there's anything tariff related, that'll obviously be pertinent for the inflation profile. And whilst Biden isn't necessarily as much of a China hawk as Trump is, he's going to have to do something to show that he's also cracking it on. So I think US-China is the only one in the geopolitical sphere that I'm kind of think could have an impact on the tape.
Yeah, there's that. The only other thing that I would add there is I like if something happens, like not specifically Russia, Ukraine, but if something happened between Russia and NATO as a whole, I think that's a whole different ball game altogether. Then
I think that's where the danger is, when you start lobbing missiles, and there's a missile over Poland for X number of seconds. But of course, President Macron will rescue us all when the French go marching in to battle the Russians. Which is
marching in with white flags in hand. Right, before we get anyone in trouble with that one, Adam, I want to bring you into this round. I mean, we've spoken about the path of least resistance leading higher for equities, the supportive policy backdrop and geopolitical developments. What do you see as the next catalysts and risks that those trading equities should really be having on the radar at the moment?
Well, I think, I touched on it earlier. I think this April 10th, I think it is, March CPI report from the US, I think that's pretty important for the reasons I stated earlier, i.e. that, Powell, he kind of downplayed some of the January and February data on seasonal impacts. I think if that doesn't necessarily follow suit with what he's saying, I think that could potentially lead to a pause in the rally. In terms of an actual reversal, I still think ultimately, if you look at what we've done this year, we've priced out 4 rate cuts and we've rallied about 450 points. I think someone at Goldman Sachs made the point. So I think the market at the moment is relatively immune to pricing out rate cuts because they still expect them to take place in some stage. I think if we get particularly hot run of inflation and that makes people question, 2024 rate cuts as a whole, then I think that could be something, but it's not necessarily my base case. I think 2 days later after that, on April 12th, you get the commencement of earnings season. So typically it's the banks that kick off earnings season and it'll obviously always be looked at, but I think they play an increasingly less important role. I think the big tech earnings will be what defines earnings season and, expectations for those are going to be particularly elevated. But as we saw in Q1 with the Q4 results, they just managed to clear well, most of them clear every hurdle in place. Nvidia, that was the one that everyone was looking at, thinking expectations is too high, and they just cleared them anyway. So I think if the big cap tech firms can't replicate their success they saw in Q1 with the Q4 earnings, that could be something. I think AI obviously is a very seen as a positive for equities. Can that be reversed? We've seen from a regulatory standpoint, the EU are coming out against some of the big US large cap names. If US regulators, regulators over-regulate and kind of suppress some of the productive benefits that people are expecting, that will need to be reflected in the price. And then, as I mentioned, it's a US election year, and tariffs are something which Trump, who's the lead candidate at the moment, marginally, that's something he's looking to impose, and that'll be a headwind for stocks as well.
Well, I think that was a brilliantly comprehensive rundown, as we've come to expect from you, mate. So on that note, let's move on to the final round of the show. Right, I'm going to say very few words here. Dick Matthews, Bank of England, give me your thoughts. I know you're their biggest fan in the City of London.
I love them. I absolutely love them. The dog that doesn't bark, which is Bailey's comment. I actually had to look that up, because I thought he was talking about the Hounds of the Baskerville, but there was a Sherlock Holmes story about the dog that doesn't bark. I don't know. He's unbelievable, isn't he, Bailey? The MPC, obviously, group think is normal, nice and easy. We may do this, we may not. And Bailey comes straight out, oh, yeah. Rate cuts are on the horizon, just both feet into it. Excuse me. I can't remember a time when the economy actually looked quite so happy as it does in the UK. Employment looks okay. Inflation, it's still high, or very high.
Hang on, sorry. I don't want to interrupt, but are you optimistic on the UK economy?
No.
That's why he's coughing.
It's an allergic reaction.
I was going to say.
I'm choking. Employment's okay. Inflation is dropping, whether that's manufactured because of energy prices playing around, I don't know. But it does look okay. I suspect we're going to get a cut. I don't think we'll get it as soon as June. I think we'll probably wait till September. Of course, the issue is, when's this election going to be? I still, for very personal reasons, to do with my wife's bill that she's trying to get through Parliament for the last 15 years, is now sitting in Parliament on its second reading. I actually think that they'll call an election very soon, and it will stop her bill going through. She'll probably walk in through the door now in a minute and kill me. I think Sunak's in real deep doo-doo. I think a lot of the MPs are going to go back to their constituency, not hear a good word about him, and they'll come back next week. And I think he's only two letters short from the 1922 committee being booted out. God only knows who they put in charge after that. I actually don't think it makes very much difference. I think they're dead and buried. But going back to the Bank of England, Bailey's obviously still in love with Powell. He'll do whatever Powell does. Cuts are coming, elections coming. And then we've got a Labour government, which should be really interesting for everyone. I say it could be an absolute nightmare, having read what Rachel Reeves said last week. I think they're going to be very interventionist, but that's irrelevant to this argument. But, cuts are coming. Bailey's still a clown. Sunak's finished. I don't know what else is news. That's pretty boring, and that's where we are as far as I can see it. I don't know.
Oh, for a brief moment there, I thought we were going to get an optimistic Dick Matthews on the UK economy, and then you reverted back to type very quickly.
It was like that meme, the one where the guy's like down like that, and approaching a car, and then he's like, "Oh, are you dying?" And he's like, and then he pulls the gun up.
Oh yeah.
You just did that.
Mr. Linton, I mean, I guess the biggest takeaway from the BOE last week was the vote split, wasn't it? I mean, the statement was pretty much unchanged from where it was a month prior, but the two hawks, Haskell and Mann, voting for policy to remain unchanged rather than a 25 basis point hike. So I guess the key question is, what are the MPC, or what do you think the MPC are really watching now in determining when that first hike comes? I think when I looked this morning, markets price about a 1 in 4 chance of that hike coming in May, about a 60% chance of it coming in June, and fully pricing it by August. What's the key data that you think policymakers are going to be looking at in this period now to determine when that hike is actually, when that cut, is actually delivered?
Thought you've been listening to me too much, Michael.
I know. You've addled my mind, Mr. Matthews.
I think, the top line summary is wage growth and services inflation. But in terms of, making a case for the Bank of England, I think there's quite a lot of complex nuances around them at the moment, because they're going to have a pretty difficult comms exercise coming up when inflation, possibly in April, dips below 2%. And rates are at 5.25%. I think them trying to manage that process is going to be relatively difficult from a comms perspective. I think I've kind of altered my kind of expectations for the Bank of England to ease. I did originally think August, but in terms of the upcoming meetings, May I think is an absolute no-go, because they need to see the data for the April wage growth, because that'll include the national minimum wage hike. But then I was looking at the calendar, and, services inflation will still be elevated by then. It's currently at 6.1%. They're hoping to get it to around 5% by summer. I think that's almost something they're going to have to live with to some extent. But I have a sneaking suspicion they're going to go in June now, because if you look at the choreography of June, you have the Fed up first. I think they're going to cut. ECB up next. I think they're going to cut. And I think that'll give the Bank of England confidence to slip one in there, with inflation possibly below 2%. I think if they were first up out of those three in June, I think they wouldn't. But I have a feeling, I think they're going to sneak one in.
Do you think they'll change their inflation target?
I think I'm less sure on this than others. I think one of the things the Bank of England has really suffered from during this cycle is their credibility with inflation targeting. And I think I listened to an interview with Alan Blinder from the Feds like a few months ago, and he said the market's perception of the Fed's reaction function is completely different to those inside of the Fed, because from in the academic sphere, a failure to get inflation back to 2% is basically saying they aren't in control of things. I think if they are to change targets, I think it will come a lot later than we think, because I think they're going to be so loath to do it.
I think it'll I mean, they haven't been in control. Well, no central bank has been in control of their inflation targets really since
pre-COVID.
He's in control of his bladder, let alone his mouth.
Oh God.
I agree, but it's a credibility, and they still need to be seen to be striving for that. Because if you then go to 2 to 3%, then the market's then going to think, okay, well, it's going to be 3.5 to 4%, and they don't want to be caught in this spiral effect where as soon as inflation goes above target, they're expecting the central bank to raise their inflation target to compensate in it. They need to be seen to do as much as they can. So I'm not as kind of bullish on them changing their inflation target that soon.
No, I think that's an interesting point, actually. And you're right in saying that, the market, there is the risk that the market anchors its inflation expectations above the upper band of whatever that target may be if it were to move. I think that's a very, very good point. Ioan, I want to wrap up the show with you, mate. I mean, where do you see not only the BOE outlook, but the outlook for UK assets at the moment? I mean, the FTSE is just shy of 8,000. Are we thinking that at long last, this might be when the FTSE breaks out and joins in with this global rally that we're seeing?
Just on the point of when overall the inflation rate drops below 2%, I think the Bank of England I think they'll be able to explain that away with the 12% cut in the energy price cap. I mean they can point to that'll be fine, and I think people will sort of be on board with it. But then obviously it depends on how temporary that is. Like it could be just 2 or 3 months or just 1 quarter. I don't know, but it's how, like Adam said, with the comms wise, they might find it difficult, like going forward. But I think initially they can point to that the energy price cap cut, and it'll give themselves a bit of time. Having said that, the split vote seems assured again, and the MPC members, they're probably looking at, economic developments as a step in the right direction. But I at the moment, I don't think it's pointing to a full-blown ease. Well, unless, CPI is really, really weak on the next print, I can't see them doing anything until, out till August wise or something. But as for assets, I don't know. Like, as the FTSE doesn't really portray the UK economy per se, right? So we've never looked at it in that regard. So I think the FTSE is tied into where the global economy is going. I don't think it matters so much what's happening in the UK. But having said that, we've got the political risk now. Everybody's waiting for when the election will be announced, and then we're going to have a lot of headline risk. Well, especially if with Labour leading the polls, and who knows what their economic policy is. I mean, if all of us in this debate or whatever, we'd expect that whatever Labour government or whatever Labour comes out with is going to be bad for the economy overall. Nobody can see how they can steer the economy any better than what the Conservatives have done for however many years. But I'm not particularly confident on whichever government or whichever party takes over government. So, as I said, I mean, I think there are a couple of headwinds coming, small headwinds, but still in terms of the US market. I think we'll be tied into that. And if the S&P keeps going, I think the FTSE will probably break free. But other than that, I think there's a bit of a ceiling at the moment, given everything that's going on outside the market itself.
Yeah, I think I would very much agree with that. And of course, you've also got the inverse correlation between the FTSE and the pound to consider as well. In any case, that does bring us to the end of the show. So let's have a look at the final scores. So things have gone exactly as the bookies would have expected them to before the show, with Mr. Linton romping home with another victory and Mr. Matthews ending up with another wooden spoon and I believe a dog as well. I'm not entirely sure where that came from. Anyway, Richard Matthews has managed to mute himself. Adam Linton, congratulations. Well done once more.
Thank you. Yeah, great show, guys. Great work.
Indeed, yes, brilliant to catch up as always, and long overdue. So we will leave things there. Thank you very much as always to Adam Linton from Newsquawk, Richard Matthews from 1.io, and Ioan Smith for joining me. I hope you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts and how you're trading and viewing the markets at the moment, and we'll be back with another episode of Trading Blows in the very near future. In the meantime, thanks again for watching, and goodbye for now.